Hello, welcome to Profiles. I'm Ed Highland. Thinking about selling a house, buying a new home, or just wondering what's going to happen to interest rates? Our guest today will help us better understand the ups and downs of what we pay for money. Dr. Stan Smith is the Suntrust Chair of Banking and Professor of Finance at the University of Central Florida. Dr. Smith's studies have resulted in nearly 60 publications, and his teaching is focused on commercial bank management and financial institutions as well as interest rates. Welcome, Dr. Smith. Thank you so much for joining us. You know, even as we speak, the Federal Reserve has been in a long ongoing process of raising interest rates with a stated intention of trying to curb inflation. But it really hasn't seemed to have an impact, at least at this juncture, on the selling of houses. People are still running out to purchase them almost as fast as they get their hands on them.
Right. The Federal Reserve controls short-term interest rates, or that's what they affect. They don't really control them, but they affect them, and those have been going up. But you're right, the long-term rates, which affect most mortgage rates, the 15, 30-year mortgages, have remained relatively flat. And that is, the markets are saying we don't expect rates to be that much higher in the future, even though short-term rates are going up. And they're probably saying we don't expect much inflation, and we expect the Fed to control that inflation too. So that's, in a way, that's a positive.
It gets very confusing for people. As we discussed before, I'm in that process of buying one house, selling another. So you try and educate yourself on what's happening with interest rates, and there seems to be, at least in my mind, a very confusing set of signals in many respects as to sort of what's happening. Like, say, the long-term rates are kind of staying down. Some people are saying, well, they should go up. The yield curve, they start throwing out facts and figures. And well, you're here to take us to school, if you will.
Okay.
Let's kind of get into a little bit of this better understanding of what is happening with this interest rate cycle and some of the things that are involved with that.
Well, again, the interest rates are basically, you have a real rate and you have an inflation expectations rate, and that's pretty low right now. One of the things that affects the consumer or a house buyer is whether they're going short term or long term. We talked about interest rates going up in the short term. Now, who does that affect? If you have an adjustable rate mortgage, it affects you if it's tied to Treasury rates or what they call LIBOR, the London Interbank Offered Rate. It also affects if you have a credit card. Because those are usually tied to short-term rates, for example, the prime rate. So it does affect a lot of people, but there's not much you can do about it. Either you get out of that debt or into some other debt.
Sure. Well, let's talk a little bit about, you brought some materials with us to kind of help us go through this process, and I guess I'll just let you launch into the
Okay.
first graph here, and we'll talk a little bit about what's going on here in Central Florida and kind of give folks a little better understanding what's happening in the backyard here.
Well, as we were talking, you're thinking about buying a house. And even if you own a house in this area, most people have seen their neighbors, even if they're not moving, they've seen their neighbor houses go up dramatically. And it's kind of like the stock market in the 90s, and people are worried about a housing bubble.
Let me stop you there for a second.
Yeah.
Now, is that realistic? I mean, what's been going on, most people would say that's just amazing that there's 10, 20, 30, 40 and plus in rates of interest gained on a house.
It is, let's talk about this as we go along.
Okay.
I'll give you
We'll get back into it,
I'll
right?
give you the answer because it depends on which measure you use.
Okay.
If we can bring up that first graph.
Okay.
What I provided there was to look at, it's called a repeated sales index. And they try to measure sales prices from the same properties.
Okay.
So you're controlling for the house itself.
Kind of like a base model, if
Right.
you will. Sure.
In other words, let's say you have a house that's 30 years old. It may have been sold 5 or 6 times. Whereas an alternative measure that we often see in the newspapers is the Realtors Association Index. And they usually give a median sales price, which is 50% above and below. But the composition of the properties that are being sold may change. So
Okay.
what you have is that you may have, one period you may have more condos, another one you may have more regular family homes. So that's most analysts who look at this market like to use this repeated sales index.
Well, that line is kind of flat for a long period of time.
It's flat for a long time. We saw some bumps. It was high in the early 80s, And if we look at that, we can see it really jumped in the last year. That jump in the last year is for the middle of 04 to the middle of 05. That's the most recent data. And if we look at that, we can see the jumps in, I'll just look at them here, 24% in Orlando, 31% in Brevard County, and 25% in Volusia County. And now the average over that 24, 25 years is about 5 or 6%. But I also think it's kind of interesting to see how they move together. And we use a statistical measure of that. If things move perfectly together, it's called a correlation of 0.1, or excuse me, of 1. And these properties move from 0.83 to 0.91 between Brevard and Volusia.
And we've got some different colors there. Let's
Right.
get some idea. That's just for
Okay.
the different areas of Orlando and Brevard and Volusia counties.
Orlando there is a broad area. It's the MSA. That would be Orange, Seminole, Lake, and Osceola counties. And they use those. They go back and do. They've got data back until the early 80s.
What was the trigger, though? What happened where you had these 5% appreciation rates basically in properties, and then suddenly 2003, 2004 suddenly went through the roof?
Let's go to, if we can, go to the second graph.
Okay. Let's start talking about it, and then we'll get it up here as we're getting into it.
The part of this gain each year we have to take into account. So we've looked at one measure, just price increases. A second measure, what they call real price increases. So for example, if your house goes up in 5% in value, but inflation went up 3%, it really went up in real terms 2%. So if we look at that diagram, we can see really it's not as strange as it looks. Because if we take out inflation, we can see there, and as the graph says, this index is normalized to that 24-year average.
And the one would be?
The one would be that average.
Average, okay.
Okay. And we can see there that it was from 80 to 90, it was a little above that, and then it went down to about the middle of the 90s and started coming back, and about 2000 hit 1. And if we look at this number, that end point, now this is the end of 2004, is 1.26. And you can say, well, the higher that is, that may suggest there's a bubble. In other words, if we look at that graph, it's higher than it's been in those 24 years. And you say, well, is it too high? That's the question we're asking.
At what point of the arc are we in?
That's right.
To make that
well,
bubble?
that's right. Just to give you an idea, too, is this same study, this information's from a study by the Federal Reserve Bank of New York.
Okay.
And I also looked at what they did in some of the other Florida markets, Tampa, Fort Lauderdale, Miami, and Jacksonville. And we're lower than all of them. So from that, you have to be careful in comparing properties or different locations. But that suggests if we are overpriced, we're not as overpriced as they are. Now, let's go on to the chart 3 if we can.
Okay. Well, while we get that set up, oh, here we go. It's coming up now. So we'll go on to it. And then I had a question about what does this actually convey to people in terms of how they can plan for purchases and this type of thing.
Well, the thing we have to worry about if you're buying a house is when you go in, you really can't control interest rates, what we started out at the beginning. You can either go short-term or long-term, and there are a lot of options out there now. Some would argue too many risky options.
And they've been making them longer. At one time, the 30-year was the norm, and now I've heard of 40, 50, and 60.
You have interest-only options. You can have decide to pay or not pay part of the time. And one of the big risk factors if you're a mortgage lender is that loan-to-value ratio. So in other words, the rest of it, you put out a down payment. The more down payment you make, the less risk there is to the lender, because you're going to protect that down payment. Exactly. If you have no equity in the home, and actually you could have negative equity in some of these mortgages, then they become a lot riskier. Okay? So when you're trying to buy a home, you say, all right, what type of risk am I willing to take, and what are the trade-offs in these different mortgages? But you've also got to say, how long am I going to be in that home? Because if we are in a housing bubble, then there's a chance the price of if you buy today and the bubble bursts, and you get out in a year or so, you may lose money. In other words, the home will be worth less then than it is now. So you have to be careful about that.
I'd say, isn't there a trap here for the consumer? Well, I know there's a trap here for the consumer because people are being told, well, we have creative financing, so we can get you into that $400,000, $500,000 house because maybe you can skip a payment or you're going to pay interest only. And everyone is hoping the bubble will continue to go on, and that price of that $400,000 house will become $500,000 and $600,000 down the road, and everything will be wonderful when you turn around and sell it in 5 years. But it doesn't always have to.
No, it doesn't. But if we look, we don't have to go back to the first chart, but that was kind of why I developed that first chart, was to say, to get a feel for if I did sell a house a year from now, what are the probabilities I would, based on past experience, what's the probability I'd lose money? And the probability was, as we saw in the graph, was pretty small. Now again, to the extent we get higher, that probability probably increases a little. But we go back to that third graph. That is a ratio that's, you hear, I sit in bank board meetings where developers are talking about what they're seeing here and also in other parts of the country. And one of the ratios they sometimes use is this price to rent ratio. And I won't go into detail too much about how it's developed, but the price is, the idea behind it is, as a buyer, you have a choice. You can either rent or you can buy. And we're going to assume that's an equivalent property. We know that's not true because you can obviously buy nicer houses than you can usually rent. But the price to rent, if the price goes up too high relative to the rent, then people will decide to rent. And that takes buyers out of the real estate market, and the prices go down or don't go up as fast. So if we look at that, we can kind of see, again, this is normalized to this 24-year average. If we can look at that, we can see it was a little above 1 in the 80s, dropped down about 90 to 2000, or 90 to about 98, dropped down below 1, and then has kind of taken off. Okay. Now let's leave that graph up there a minute, because some people say that is, and the study I'm talking about says that's the wrong way to look at the rent, the price to rent, because what they're saying is we want a more detailed estimate of what the ownership cost is. And it's things like, if you have, for example, the median price here in Metro Orlando is, let's say it's around $250,000. So if you have a $250,000 house, you just pay for it, then you could have put that money into something else. For example, you may have been able to earn 5 or 6% on it. So let's say it's 5%. So a $250,000 house, your earnings on that would be $12,500. Okay, so that's part of it. You have additional costs such as property taxes, maintenance costs that you don't have as a renter. I mean, it's built into the rent, but you don't have it directly. But you also have a reduction in costs such as you itemize your tax deductions for property taxes and mortgage interest. Then that has a value and reduces your cost. And then the other factor is expected capital appreciation. Because if you expect those prices to go up over time, and we saw that they generally have, then that lowers your cost of ownership, because if you rent, you get none of that. And this is kind of interesting. If we get time later, we may talk about, if we look at that perspective, they're talking now more seriously in the past week or two about lowering the value of those tax deductions. And if they do that, that raises your cost of ownership and could have a negative impact on stock prices.
Certainly, that's a long-term kind of effect that actually upends what has been the tradition.
Well, I know based on some research I did in some commercial properties in 1986 Reform Act, Tax Reform Act, if you're in a fast-growing area, it won't affect you as much. But if you're in a slow-growing area, we saw that the Tax Reform Act of '86 lowered office values by 25% just from changing the taxes. So people need to be careful and really understand what they're doing.
I was going to ask, just out of curiosity, because you've got the charts here, which obviously follow a certain flow and pattern based on people's habits and what has taken place. But we kind of have some wild cards, especially in the Orlando area, in the sense that there's a lot of transient population here, meaning people come here for sometimes lower paying jobs. They are demanding apartments because they cannot afford necessarily to buy housing. So there's kind of a shortage in the apartment side.
And it appears to be getting worse.
And appears to be getting worse. And that, I would assume, has an effect on prices because people can charge more for rentals. And the story has been, at least in the recent years, that home builders can't keep up with demand because of people moving here who are demanding houses. So we have this huge demand structure which is in place as well. So interest rates, which are set and are affected more on a national sort of level, for us aren't necessarily the factor as much as just plain availability sometimes.
Well, that's true, and you're seeing it if you look at just the same newspaper articles we all read, in the Sentinel or other newspapers. You have a lot of condo conversions going on downtown now, so that means those what were apartments are no longer available. So those rents are going up. So I think some people are estimating they'll go up 10% this year. You have a lot more people moving because of the affordability. They're moving away. There was an article recently about how a lot more people are going out to Lake and Osceola counties just to be able to afford a house on their income.
Yeah, kind of a forced spreading of the population, which causes sprawl and growth.
But then we also have a lot of people coming in and people who come here are not necessarily all low service, low service jobs. And the people who are coming in from out of states, even though we think this market has increased quite a bit, Orlando is still very cheap to a lot of parts of the country. So if you're coming from the Northeast or Midwest, you've probably made a lot of, you can get a much bigger house, probably a nicer house here than you had for the same money or maybe even less money.
So the appreciation rates that we're seeing here in the Orlando area, which is a high demand type market, really are being reflected in other parts of the country as well.
Oh yeah, yeah. In fact, I think that when we looked at that real price chart, the national, we were 1.26, the national average was 1.39.
Okay.
And all the other areas in Florida were higher than we were. Now, another thing you want to look at is that where you're looking at home development, most of that is taking place in about 4 or 5 states. So you'd have California, Arizona, probably Nevada, Texas,
Las Vegas area.
Florida. If you look at where all the major home builders are, that's where most of their action or building is.
And before moving here, I was living in the Midwest, and their economy, at least their home sales and such, while they were doing okay, the home building market was relatively flat, and housing prices were relatively flat. I mean, it was incredibly cheap to live there, and that was because people weren't moving there. It was not a high demand type area as well. So, well, let's go on to a discussion and kind of get into, again, how all of this kind of figures in your planning process. Because we're looking at the graphs and we're seeing the changes that are taking place. And let's say you're watching the interest rates. You see some of what you've got here in the way the growth curve is taking place and home appreciation. And yet you're kind of wondering, well, can I wait another year? If I'm thinking about selling my house, is now the time to do it? Can you even look at the type of information we have at this point and get a real feel for where we are in this cycle? And maybe I should ask, is it a cycle? What goes around comes around?
That last graph we were looking at, they have that estimated rent or imputed rent they talked about. They did a measure where they compared that to actual rent. And it was very high in the early 80s and then went down. That it's imputed rent to actual rent or something similar. And the idea being, going back, that if your imputed rent is lower than your actual rent, relatively, you're going to buy because it's a better deal. And what they've done is they found in the ratio in Atlanta was, let's see here, I apologize, I want to get this correct though, was 0.88. So in other words, if you look imputed rent to actual rent, we're actually lower than we have been for this 24-year period. Now that was the end of 2004, which that suggests we have room for more appreciation. Now we've had part of that in 2005. Okay. But if we look at that measure, and like I said, the economists who look at this nationally would suggest that we're not overpriced at all. I mean, which is, if you own or you're thinking about buying,
actually, when you think about
well,
it,
it is. But and again, it goes back to what we were talking about earlier. If you look at that imputed rent compared to actual rent, because what are we saying? Even if your cost of owning is going up because of various reasons, what's happening to actual rent here? It's also going up. So you're not out of line. It's still, if actual rent goes up, that means your price you can pay for the house is more justified too. So, like I said, we've looked at 4 or 5 measures, and you get kind of different pictures depending on which measure you use. But if you use the most accurate, I think, we're not overpriced, and we still have room maybe for just a little bit more before we get back to kind of a normal level. What is kind of interesting, though, is looking at our sister metro areas here in Florida is we were at 0.88, Tampa was at 0.98, Fort Lauderdale was at 1.07, Miami was at 1.12, and Jacksonville was what we are. And these economists say that it's possible that Fort Lauderdale and Miami are a little overvalued, even on that measure.
Is there a way to explain why we've managed to stay at the level we're at and been more affordable?
I think we've had, well, if you look at Fort Lauderdale and Miami, they don't have as much land. In this study, what they tried to say is, one of the things they looked at was how much of these house price increases are related to construction costs. I mean, those of us who tried to get a roof this past year after Charlie or a pool enclosure or anything like that know materials and labor costs shot up. But they looked at that, not just the hurricane situation, but they looked at it and said it was not due to the construction costs, it was because the land. Now you've got the property, you've got the building, and then you've got the land. It's the land is increasing in value more than the construction.
That's the old saying, they're not making more land.
Right, location, location,
exactly.
location. And if you look at Fort Lauderdale, Miami, they probably have a lot less land to develop than we do in Central Florida. But even there, over the next 10 years or so, that land will be developed. And I know here around the university, this is my 10th year here at the university, and there's a lot less developable land now, particularly in Seminole County, close to the university than there was then, and that's probably part of the increase in real estate prices.
And certainly the demand is there. People who work at the university or want to be close to it certainly are willing to pay the
research
premium.
park and
exactly.
Others.
Let's take and get just the last graph. We've got a little less than 5 minutes to incorporate that and talk a little bit about rent-to-income ratio. Wanted to get this one in, so
well, this is another ratio, and like I said, this looks almost like the third graph we looked at. But I hear a lot of people, and I've heard this for a few months from developers saying that they thought that they were worried about a housing bubble here in the Orlando area because of this rent-to-income. Or excuse me, no, this is price to income. The price to income ratio is the lighter line there.
Okay.
And the idea behind this is that the two ratios that a lender will look at is your loan to value, which we talked about, and your payment to income. Obviously, the higher the payment is relative to your income, the more risky the loan is. And the argument being that what they usually use on this payment to income, or excuse me, the price to income, is the median per capita income. And you have to be a little careful about that because the marginal buyer may have a higher income than that. Particularly here in Orlando, where we have a fair amount of low-paying jobs. But if you look at that price to income, we are above that 1 right now. But again, it goes back to, if you look at it to that relative to the imputed rent, we're still in good shape. We're even better shape than we were just talking about a second ago. So again, we go back to this. It depends on which measure you look at. You get different pictures. But the best measure, at least I think, is saying we're not overpriced. Now, everybody though is saying we're not going to have 25% gains for the next year or two. I mean, we probably will go back to that 5 or 6%, depending on what inflation is. Mm-hmm. So if you bought in the last couple of years, you made out real well. Because, and again, I know our real estate prices in my neighborhood really were, I mean, they were growing, but they weren't growing very fast until the last 18, 24 months.
In the last couple of minutes we've got here, at some point there will be a leveling out.
Sure.
Whether you would call it a bubble bursting or not is almost immaterial. But at some point it's going to level out. Traditionally, historically, is there a great loss in home values? I mean, isn't in Orlando looking at people losing values in
no,
homes?
I don't think so, particularly if you don't think it's overpriced. But and there have been studies on this, and they'll vary. Sometimes they say that when the bubble bursts, it takes 3 to 4 years. So it's generally a slower burst, unless the things they have to worry about where we'd have a dramatic impact is if interest rates really shot up. And none of the economic forecasts I'm seeing now, for example, over the next couple of years has it. I think mortgage rates recently were just a little under 6% for a conventional 30-year mortgage. I'm not seeing any forecasts more than 6.5% for the next 2 years.
Which is still a comfortable level.
Oh
for
yeah,
most buyers.
yeah. I mean, that's not going to dramatically affect the people. The economy can affect people, but we're fortunate. I mean, we have the problems of growth, but from that perspective, we're fortunate in that we will continue to see growth. People still want to move here for jobs and for retirement and just for the nice weather. So I don't think we have that much to worry about. You may not make big gains over the next couple of years, but you're probably not going to lose much either.
So your retirement bankroll that you were counting on your house to be is probably safe, at least at this juncture.
Well, it is probably safe. The problem is if you're going to retire here, everything it doesn't do you much good because you're still going to have somewhere to live.
Sure. Can you afford to
right.
buy that
I mean,
house?
everybody would love to sell their house now, but there's nowhere to move that would be anywhere necessarily cheaper.
Well, Dr. Dan Smith, thank you so much for coming by and sharing your insights and giving us a better understanding of interest rates and what's going on in that world, which can be incredibly confusing. I mean, anybody that's signed to the bottom line for a house can certainly relate to all this, and we appreciate your insights.
All right, my
pleasure.
pleasure.
Thank you so much. And thank you so much for joining us for another Profiles. I'm Ed Highland. We'll see you next time.